We're going to take a look at Treasury yields. Right now, they are tumbling after August non-farm payrolls missed expectations. Yields have been under pressure all week as economic data heightened September rate cut expectations. Traders now pricing in a higher chance of a 50 basis point rate cut rather than 25 basis points. And it was really interesting to see those moves. We saw on our CME Fed Watch tool here just a decline in terms of the degree to which traders were pricing in a 25 basis versus 50 basis point cut. And you can see the pressure on yields across your screen right now. You're looking at the 5, 10, and 30-year yield on your screen right now. So what can we expect from here for the fixed income market? We've got George Catrambone. He is the head of fixed income for the Americas at DWS Group. George, it's great to have you on. So let's just start about what we're seeing in terms of the bond market's reaction to this data and what that's going to tell us about the Fed's next moves, 25 or 50.
Sure. I think there's a little bit of a sense of relief because, whisper number was around this level. I think consensus was 164 or so. You came in lower, but not low enough to cause a large issue. So I think right now you're seeing the yield curve steepen and disinvert. We've had an inversion for a very long time. So to see that steepening come in, but it's the revisions that are the large problem here. This is now month after month of revisions, 111,000 or so revisions a couple months ago, a very soft July report overall with a lot of distortions, and now additional 2-month revisions. I think the bond market is looking at this. And now it's going to be incumbent on, I think, the last two speakers that are coming in. I think it's Williams and Waller. Yeah. They're the last word before we get into the blackout period to kind of clue the market in as to whether or not it's 25 or 50 from here. Right now, I think futures markets are pricing right in the middle. Maybe there's a 35 basis points or so priced in for the upcoming meeting.
So what type of duration should investors feel comfortable adding into their portfolio at this juncture?
Sure. Well, hopefully people were taking advantage of the duration when the entire curve was above 5% and starting to extend out. I think what worries me is the fact that people aren't talking about the $6.5 trillion in money market funds. So I think that's also part of the story, that it's not being priced out yet, and people are still sort of waiting in a complacent fashion. And I think that's a little bit behind the move that you've seen within that yield curve starting to disinvert. So I think, and overall, yields kind of come down amongst the curve, amongst a more difficult data set. I mean, people are looking at NFPs today, but let's also talk about JOLTS. Yeah. Let's talk about Beige Book, which Powell's going to be staring at and the Fed committee will be staring at, if not already going into next week. So I think you need to start to press out. We still find the belly attractive. Maybe go in 2 5s and short, maybe long end towards 20s or 30s, start to take advantage of that steepening. Investors need to remember, though, it's not actually the inversion that causes the recession. It's the re-steepening of the curve itself that actually coincides with recession, if it were to occur.
I'm curious about the Beige Book that you mentioned. To me, that was my favorite point of this week.
Love that.
Being a little bit of a nerd over here, but you had 9 of 12 regions showing cooling. We know that Powell loves his anecdotal regional data. It made me think he's going to be gunning for 50, but the rest of the folks may not be on board for that. And again, we're still seeing the market kind of bopping around between 25 and 50. If you had to say what the bond market's telling you right now on 25 or 50, what would you say?
I'd say it's telling you 25 potentially in September, but that doesn't mean there's not a 50 in November or December. Yeah. I think that's effectively what it's saying, pricing at about, potentially 100 basis points of cuts this year. I think it starts to get ahead of itself with 9.5 going to 2025 and still saying we're going to have a soft landing. I think that's where it's a little bit of a question mark for me.
Right, because there's a reason that we would have to see 9.5 in order to, in order for the Fed to justify, and it would have to be a harder landing or just all-out recession, which, we'll see if the NBER would even have declared it by that point.
Correct. Usually it's too late by the time you get there.
You're right.
But yes, I think overall there's a lot that Powell's going to have to sort through, and that's the direction of travel.
Really quickly, I want to talk about the yield curve disinverting. Just explain to our audience why that is such a big deal for this market and why we pay attention to that.
Sure. Obviously, when rates quickly move up, and we're moving at 75 basis points a clip just last year, 18 months ago, right? So that pushed front-end yields up and sort of long-end yields down because the risk theoretically is on the front end and overnight money, and the risk is right in front of you. So as the Fed starts to then ease that policy and get back to a more normalized curve, that front end should come down, and then the long ends start to go up and create more of a normalized growth trajectory. Typically healthy, but as you go from disinversion to inversion, that's normally sometimes when you see some stress in the economy actually start to show, although in a lagged way.
Right.
Really good stuff. All right, George, thank you so much for joining us on the heels of that report. We really appreciate it. George Catrambone, DWS Group's head of fixed income. Appreciate it.